So we're going to talk about the effect of delta on the long call strategy. So what you're looking at here is a quote screen for SPY, and we've got call options, and you can see we've got the delta underneath it. And we've got two different expiries, May the 27th and January the 20th. So we're going to talk you through an example now in a moment. But first let me remind you of what delta is. Delta is the rate of change in the price of an option for a $1 move up or down in the underlying share price of the stock. So let's look at the SPY 208 January 2017 call options. We can see here that the bid and ask price is 10.25 and 10.41. So we decide to buy the 208 calls at 10.41. So now let's work out what this delta position means. Well, if the share price of SPY goes up by $1, our long call position will be worth 10.25. So notice the way I use 10.25 here plus the delta of 51. So I didn't add the delta onto what we paid for it, because remember, if we were going to sell that call option, we would only get the bid price. So add the delta on to the bid price, so it's 10.25 plus 51. So if the share price went up by $1, the value of that call option will be worth 10.76. That would give us a profit of 35 cents per share because we paid out 10.41 for the call option. But what would it mean if the share price went down by $1? Well, our long call would be worth 10.25 minus the 51 delta, which would be 9.84. So we took away delta this time because the share prices dropped by $1. And that would give us a loss of 57 cents a share because we bought the option at 10.41. It now would only be worth 9.84. So that would be a loss of 57 cents a share. But what if the shares moved more than $3? What would that mean for us? This is where the next Greek comes into play, which is gamma. So we're going to talk about gamma in the next video, and then we're going to bring all of this back together in one big presentation showing you how moves up or down in share prices will be affected by delta and gamma.